Welcome to the National Credit Awareness and Resolution Association podcast at ncara.org, N-C-A-R-A.org, your source for navigating debt repayment challenges during tough economic times. Today we'll explore how small business owners can more effectively use Creditor Tools, specifically the Credit Approval Memo. NACARA aims to bridge the gap between debtor and creditors as a paradigm shift allows debtors to propose their own repayment solutions. Let's get started. The Credit Approval Memo. Underwriting a new or existing credit relationship is a complex undertaking. After an initial loan screening where the lender wants to do the deal, they will gather a complete underwriting package. The underwriting will be summarized in a comprehensive credit approval memo or presentation called by various names. The credit approval memo will be prepared by a credit analyst, a primary relationship officer, and presented to a credit administrator or a loan committee, depending on the size, for approval. Similarly, where there are credit actions to be taken throughout the repayment period, other documented credit approvals are also prepared. The original credit approval memo will be a summary of the underwriting and may include the loan amount, the borrowing cause, loan purpose, legal entity ownership, management, business operations, the product, services, tenure, marketplace, competition, guarantors, the interest rates and fees, primary and secondary repayment sources, the maturity date, the collateral, individual credit reports, financial statement and tax return analysis, which would include the balance sheet, the income statement, the cash flow, global and pro forma cash flows, trend and industry ratio comparisons, the risk rating or loan grade, any loan covenants, and even environmental risk. All these data will be gathered from business pertinent financial statements and tax returns generally for the last 3 years, plus year-to-date interim financial statements, including any legal entity guarantors, and personal financial statements and tax returns for each of the individual personal guarantors. It's a very big deal. So, what about putting together a good deal? A credit analyst may be responsible for performing the detailed financial statement and tax return analyses using the 3 years of financial records. Understanding these reports will enable the creditor to clearly see the financial condition and trends of the business and the prospect for funding a loan request that will get repaid. Each component of underwriting is important, and the cash flow and the global cash flow analysis will be used to confirm the ability to repay the loan. Additional detailed financial reports may be required, including accounts receivable, accounts payable, other aging reports, inventory reports. The analyst will recommend the loan structure, including any covenants to obtain future financial statement information and targeted financial performance benchmarks. The loan pricing and fees will also be determined. This information will be assessed and analyzed so those with delegated loan approval authority can make an informed decision whether or not to grant the loan. Most creditors are subject to certain regulatory and supervisory guidance to conduct safe and sound lending practices. Prudent underwriting and loan structure are critical to the creditor's long-term success. Creditors are also required to conform to applicable laws and regulations in the application of granting of credit in the credit process, and there should be no discrimination of any applicant. What about delegated lending authority and exceptions to the policy and the renewal timing? Lenders routinely give specifically delegated loan approval authorities to their lending officers. The larger and more complex the credit relationship, the higher authority levels are required. This may include a loan review committee comprised by members of the board of directors, who will also review certain loans made since their last meeting. Active oversight is a key function of the directors. Depending on the size of the lender, Lending authority may be delegated to the Chief Risk Officer, which is a CRO, Chief Credit Officer, the CCO, or a Chief Lending Officer, a CLO, credit administrators, or relationship managers, and even individual lending officers. The latter will have primary responsibility for the preparation of the credit approval memo or presentation, together with the assistance of a credit analyst. Should the underwriting include terms and conditions that don't conform to the lending policy, those items will be listed as exceptions to policy, together with the documented reasons that mitigate the increased risk. Loan covenants can be installed to control certain risks. The credit decision process will include enough time to allow the approval authorities to make an informed credit decision and close the deal before the loan commitment expires. On existing loans set for renewal with a pending maturity date, like those loans with large balloon payments or revolving lines of credit, the underwriting for these deals will take place about 2 months before those loans mature. Approvals may have a commitment period, like 30 days to fund. Funds will not be dispersed until the creditor's collateral liens have been properly recorded or perfected. Now, this short ad is sponsored by the Debt Crisis Problem Podcast. Attention listeners, please join us at tunabudget.com to tune into the Debt Crisis Problem Podcast, where in plain English we discuss the 20 risks that could soon fuel a serious economic downturn. We explore critical risks that could trigger economic downturns and offer practical insights for navigating financial uncertainty. Join us for thought-provoking discussions that encourage transparency and awareness. Subscribe now to stay informed and be ready for whatever comes next. So why is understanding more about the credit approval memo and the process important to you? Build on your existing experience with your lender. Your business financial condition is what it is, and hopefully you expect its performance to improve. Maybe it is greatly underperforming compared to what it was at the time of the original loan, but that's okay. If you have a history with the creditor will know and understand generally why things are the way they are during a financial downturn. If you've been forthright and have a trusted relationship, you are likely to be inclined to continue to tell it like it is. You will provide timely financial reporting that the creditor will use in addressing your workout loan or loan modification. By the time you provide any requested information, the creditor should clearly understand the root causes for your specific financial deterioration and be sympathetic to your plan to repay. Ask the creditor if it has any questions or needs further information. Now, it is natural to avoid a creditor or get frustrated when there's been a downturn. It may even feel like a Grand Canyon has suddenly split between the two of you. But if you're taking real ownership of your business, figured out how you intend to repay your loans, you should be eager to provide the creditor with any requested information so it can complete its underwriting. The more communication, display of good faith and goodwill, the better. Expect the lender to negotiate similarly with you, with respect and good faith. You can only do what you can do, and being completely forthright and honest about it, there's a better chance than not that the creditor will agree with your repayment proposal. Maybe it will or maybe it won't, so negotiate if you need to. That's perfectly acceptable. Whatever you do, don't lose your temper. No contention, as you'll quickly be branded as being an uncooperative borrower. When that happens, the lender will likely turn to their legal remedies and not want to do further business with you. Better be prepared to whip out the checkbook if the relationship gets too bad and legal fees appear. In the end, you and the creditor should be on the same page, and an agreeable solution will be well documented on a credit approval memo. All those areas that I've just mentioned. You can fill in those pieces to that puzzle. Prepare for the lender to thoroughly document the responses to each component listed in the credit approval memo. Once approved, you can put your focus and attention on making the plan a reality. You are more empowered to come up with your own repayment solutions to repay your own debts. It's not just the lender that has a say in this. An open, communicative relationship with a creditor is essential. Let there be no Grand Canyon of misunderstanding between you and your creditors. May each creditor clearly understand their borrower's best efforts to repay their loans with their own solutions, and work with each one as much as possible. Thank you for joining us. Today we covered the Creditor Tool, the Credit Approval Memo and process, as debtors prepare to propose their own repayment solutions. And we want to hear from you. Share your own credit risk memo and debt repayment experiences, questions, and recommendations with us at nicara.org. If you found today's episode helpful, please subscribe for notifications of future podcasts. Your feedback helps small businesses stay in business. Until next time, step forward and take responsibility for your own debt repayment solutions. Thanks again.